I'm excited to release this episode with Boris Wertz. Boris and I had previously recorded an episode a couple years ago. He's one of the earliest guests on the podcast, so it was super fun to revisit, sit down with him, and record this one in person. Boris Wertz is the founder and general partner of Version 1 Ventures. He was founded in 2012, and with over $250 million in assets under management across 6 funds, and they have backed over 100 startups. They invest in SaaS, marketplaces, emerging technologies, and industries such as crypto, Web3, bio, energy, climate, AI, robotics. They invest in everything. Version 1 is based in San Francisco and Vancouver, and it was a lot of fun to dive into this episode with Boris. We touched on a variety of different subjects. I got questions from some of the companies he's invested in, like Jobber and Ada. Shout out to the founders there for some great questions. We talked about his interest in India, liquidity, and much, much more. This was an awesome episode and great to dive further into Version 1, the background, and the story. Before we jump into the episode, I wanted to shout out to the podcast supporters who make this podcast possible. VanHack. Let me introduce you to VanHack. Startups of all sizes choose VanHack because they only offer handpicked developers with 3 or more years of experience and who have strong portfolios. Great Canadian tech companies like Neo Financial, Air, Wattpad, Applyboard, and League have worked with VanHack, and they had an amazing experience. Go to vanhack.com and check out their talent pool without having to log in and see for yourself. And when you sign up, tell them Evan from The Hard Part sent you for a 25% discount. Float. Float is a complete business finance for Canadian companies. They offer modern financial services, powerful software, and industry-leading support designed for every industry and stage of growth. Their integrated suite of products include corporate cards, FX, bill pay, expense management, and high-yield accounts. They give finance teams everything they need to manage spending and cash flow efficiently so they can keep pace with the demands of their business. To learn more, visit floatfinancial.bloom. Just because the economy is uncertain doesn't mean your shred claim has to be. Bloom is all about predictable value. They're the only shred firm that guarantees their work. They meet with you every quarter and show you exactly how much you've accrued. And their pricing is posted online with a cap, so you know what to expect. No guessing, no surprises. Head to sred.ca, that's shred.ca, and see why more Canadian investors are choosing Bloom as their shred partner. Without further ado, here's my conversation that I recorded with Boris Wertz a few weeks ago in Vancouver. Please enjoy. Thanks for doing this. And I'd love to start with some questions I got from David and Mike at Ada. And they're kind of just curious on different patterns, different things that you've seen in founders. You're known for investing in founders. So what kind of things are you looking for in them? And also David has some questions about just kind of the current AI wave and if that fits kind of how you've historically kind of made investments, looked at founders.
Yeah. Just had dinner with both of those guys last night in Toronto, so it's appropriate to start with those questions from the Ada founders. So we're definitely at kind of, given that we're an early stage firm, for us it's all about founder quality. That's really at the core of the decision-making process, right? And we define our kind of founder as this mission-driven founder that is deeply passionate about solving a specific problem and brings along that ambition and persistence to go through kind of the walls, the tough periods, to get this problem solved. Startups are really hard, right? And they take a long time. And if you don't care deeply enough about the problem, you're just going to give up at some stage and move on, right? Yeah. And we want to be in business with founders that go the extra mile, right? Don't give up. And there's numerous examples in our portfolio where founders just refused to give up and finally found product market fit, finally found the market traction, while everybody else had kind of moved on and kind of moved away from a certain category or market.
Yeah.
Now, we love especially founders that are early in new categories and new ways, right? We always think about it needs to be so early that the category doesn't even have a name, right? That's the ideal thing. That was vertical SaaS in 2012 to 14. Nobody really talked about vertical SaaS as a really interesting category. Yeah. That was definitely crypto in 2016 to 20. AI, on the one hand side, completely fits that, right? Because obviously a big wave. It's still early, even though kind of things have accelerated in the last 2 years. But it's also a little different because it's not necessarily this overlooked area. I think everybody is aware that this is probably the biggest transformation technology we have seen ever. It's also moving super fast. Lots of capital available, right? And lots of obvious ideas. So on the one hand side, it is one of these interesting waves that we want to be involved in. At the same time, all the dynamics around it are a little bit against our investing style of looking for overlooked founders, overlooked opportunities, the non-obvious things, right? Lots of things about AI are obvious right now, right? And so that's kind of the challenge that we have as a firm.
Has your like founder first investment thesis evolved over the years? Has it changed at all? And like, how do you kind of operate in a space where like you meet a lot of smart people, a lot of intelligent people, but then how do you kind of distinguish that from like finding that exceptional individual? Like, I'm just kind of curious, in a world where you're probably constantly hearing amazing pitches, meeting amazing folks, how do you like really kind of pick out that outlier? And maybe you don't view it as like an outlier thing, maybe you view it a different way, but.
Yeah. So I think it really comes down to just improving your filter over time and how you express and kind of word that filter, right? I think we always had a filter for kind of these potential outlier founders, exceptional founders. It obviously gets better over time, right? And it obviously, you get better at describing what really matters to you based on kind of the mistakes and successes you had in the past. I think the challenge in evaluating founders is twofold. The first one is there's no one founder, right? That is like one founder pattern that is right, right? Because then you get really to the obvious founders like Stanford, MIT, whatever kind of came out of Google, came out of Uber, came out of Facebook, whatever. That's not our type of founder. So you really have to go back to first principles, right? And think about like, why is this a special founder or not? And that's much harder than just looking at some specific career path and background that matches your filter. I think the second thing is like the really great founders are in a certain way a little crazy, but positively crazy. They're so passionate about it, right? That it's sometimes hard to differentiate is like, what is like just drive and what is perhaps a little bit too much fiction in a certain way.
Interesting.
Right? And so we always think about like, what is the crazy good founder, right? That has like this incredible ambition, this incredible passion, but also knows how to kind of pull it all together, motivate a team, build a company, plan to go to market and create value for everyone involved.
Sam at Jobber kind of has some questions around like multiple generations, so like Gen X, Millennial, Gen Z. Have you seen different kind of traits or like differences between different generations? And like kind of tied into that, just with your focus on India, which we can dive more into, but just like, is there a different mentality with like an Indian founder versus, you know, maybe compared to Canada or US?
Yeah. So first of all, I think like the founders represent a little bit the waves that we're investing in at the time, right? So I think when you think about the SaaS wave, these were often a little bit older founders, a little bit more down-to-earth founders, and also the SaaS wave, you felt like you had a little bit more time to build your brand, to build your go-to-market, to find product market fit, right? So I think in a certain way, like thoughtful builders, long-term builders, not necessarily kind of people that were measuring progress in weeks and months, right?
Yeah.
When you look at the AI wave, like everything has accelerated, right? And now we measure progress literally in days and weeks, right? And at the same time, everything has gotten super noisy, right? And so I think as a founder, to be successful in this environment, right, you need to be not only like fast iterating, you also need to perhaps a little bit more shorter term focused. You need to be extremely good at getting your narrative out versus other people's narrative, just to cut through the noise, right? And so I think it's a different type of founder depending on the way, right? I would say the founder qualities between different countries it's less between different countries. I think it's more between the size of the ecosystems where they come from, right? And I would say people that have seen other founders in action, for example, in the Bay, and have lots of role models, are probably kind of more baked founders in a certain way, right? While other founders from India, from Canada, from smaller ecosystems, perhaps haven't really seen as many other founders that they could learn from, emulate their kind of actions and how they build companies. And so they sometimes have a little bit longer to learn and kind of grow.
On the topic of India, like what's been really interesting to you there? I know you've said like India for India is kind of like a theme. Like what's got you really excited about there? And I know you've been spending more and more time there.
Yeah. So I started spending time there 2 years ago. And I think what is really interesting in like kind of the investment thesis is really on kind of three pillars. The first one is like this India's fast-growing population, fast-rising middle class, the China plus one strategy. Everybody wants to kind of be less dependent on China, and India plays a really huge role. India for India kind of plays on all of those themes, right, with very unique approaches. So it's less kind of business models you've seen in North America, and then somebody comes in and it's like, does X for India, right? It's more very specific platforms, marketplaces, opportunities for India. So for example, we invested in the largest EV charging network for 2- and 3-wheelers in India. And that is only possible because the OEM market for 2- and 3-wheelers is extremely fragmented, about 100 OEMs, and you need somebody that builds a charging network on top of those EV OEMs, right, to enable charging at home and charging on the road. I think the second pillar is we've just met incredible entrepreneurs that are at par with the best entrepreneurs in North America. Extremely passionate, extreme hustle, very smart, very technical, and we just love the founder quality and everybody inspiring to be to build a really large, ambitious company. And then last but not least, I think it's underserved in terms of just venture capital, right? There's lots of really small funds. There's lots of Series A funds, but there's very few in the middle kind of institutional seed. And that's where we see our opportunity. That's our sweet spot. So kind of on these three pillars, like generally super interesting geography and unique opportunities to kind of build for India. Exceptional entrepreneurs, and then kind of what feels like a lack of institutional seat in India.
Whether it's India or like other kind of themes or kind of like tailwinds, like how are you kind of like looking at like okay, before like crypto is very obvious, you're kind of diving into it. How do you kind of like learn about these things, kind of get a better understanding, build conviction around it, build a like, hey, like we think it's directionally going this way. Like how do you kind of like do that? Is it just time spent in it? You talk with other folks, like whether it's a geography or kind of physically there, like how do you kind of look at that?
Yeah. So first of all, you always have a bunch of things that you're kind of interested in. There's some verticals where some categories that just come naturally much better to you than others. So at version 1, Angela is much closer to deep tech than I am, right? But I was much closer to crypto than she ever was, right? And so you just naturally have a little bit more affinity for one sector versus the other. I think one of the indications we always see is just like the quality of the entrepreneurs we meet in a specific category, right? Like if you see that some of the best and brightest spend time in that area, coming up with solutions, coming up with company ideas, then there's a real traction in the market, right? When we see that interesting entrepreneurs flocking to a certain category, to a certain technology, that's where it kind of starts to become interesting to us. But having said all that, while we're trying to understand the basic drivers of what's happening, we're not going to be experts in all of it. You can't be an expert in crypto and in bio and in India and in robotics, right? It's just impossible. You try to fully understand, like, what are the drivers? How does it work building a company in that space, right? What are the most important factors? But then you have to kind of trust the entrepreneurs that are pitching you. Trust your filter that you pick the best entrepreneurs, that they're going to come up with the details of how they're going to go about it, the technical solutions, because there's no way you can diligence those better than these entrepreneurs that are building in that space.
With the filter, obviously it's a bit of like intuition, and also like you've been doing it for a long period of time. But like, do you have like specific questions? Do you like want to see people in person? Like what are some like really tactical things that have worked well for you?
Yeah, I mean, super tactical. We'd love to meet people in person. It's not always possible when kind of a round moves a little quicker or kind of geography doesn't line up. But in person is always better than over Zoom. I think deeply understanding kind of where they're coming from, why they're building that, what they're building, right? Sometimes it's something that they have been thinking about since they were kind of a teenager, right? Sometimes they have been working on different side projects over the last few years on that specific question. But really, when we say mission driven, we don't want to see that mission kind of originated last week, right? Because that's the first time you thought about that problem. Truly mission-driven people have been thinking about that problem set, that category for some time, right? And perhaps have tested a few things to kind of figure out the best potential solution to it. I think we also, we ask a lot of details about how they think about the different stages of building this company, about details in the business model, about product. These really top-notch founders, they have thought through all of these questions. There's not a single question that should surprise them that they have never thought through, right?
Yeah.
Because if you're really passionate about building something, if that is where you're spending every awake minute, right, you have thought through all of these questions. So we're spending a lot of time there. And then just also speed of iteration and urgency, right? Like the way, how quickly do you respond to an email? How quickly do you set up a meeting? How quickly do you follow up from if there's any follow-up items, right? Do you make that, what is your pace of operation, right? Like obviously everybody, like a fundraising process can take some time, right? But you have to have the feeling that people iterate at a pace, right? That they get things done very quickly. And if fundraising is the biggest priority at this moment, then they should get on it very quickly.
100%. What do you kind of focus on like after you made the investment? Like what do you usually like kind of find is like the best relationship or cadence with different founders? And obviously maybe it's different every time you make an investment, but like what do you kind of like choose as like a role post-investment?
Listen, I think we try to be as helpful as possible, but as you say, that's very specific to the founder and to the situation, right? There's sometimes founders are heads down developing products and an investor can't really do much during that phase, right? But then there might be the moment where you build your initial team and you want to have a second opinion on hiring, or you want to convince a key early employee to join the startup where we can be helpful, or you raise your next fundraise and investor introductions and feedback on the deck and whatever it is. And suddenly we become very, very much involved, right? One thing is completely clear, right? Is the founders need to run the startups. It's all about them. We can give advice from time to time, but ideally the question comes from them, right? And they're thinking about these things and they think about how to involve the investor versus us kind of pushing for things. And you develop a relationship where I think you become a really trusted advisor for them to come and run questions by us that they struggle to kind of figure out and want to have different points of view and perhaps different perspectives while still ultimately taking the decision.
How have you thought about kind of structuring version one? Like in our previous recording, you kind of said, fund size is your fund strategy. How have you thought about kind of fund size, team structure when maybe others have like, they add lots of people at the firm and all these platform teams and stuff, and you've stayed relatively like lean with you and Angela and some other team members? Like, how do you kind of think about how you've structured version one?
Yeah, so I think we do a very specific style of investing, right? And that style of investing has three characteristics. The first one is like quick to conviction, right? In early stage investing, you can't really run many data requests. Either you feel that this is the right founder and opportunity very quickly, or you just move on, right? You obviously don't get it always right, but quick to conviction is very important for us. Second one is like this high energy, high hustle all the time on, because we feel like in the same way that we want to invest in founders that have like high energy, we want to be high energy, right? And then the third one is like always curious, and it comes back to these like what are the next waves, like what are the new technologies, and being always on top of interesting things that are happening in the market and where the innovation happens. All of that is best done in a very small team, right? An analyst doesn't help you. An associate doesn't really help you to get to quick to conviction, right?
Yep.
This is all that we as investing partners have to get to. The more people you involve, the more diluted down becomes the decision, lesser energy you have as a group, right? And so we're firm believers for the style of investing we're doing, it's best done in a very small team. That team doesn't have to be 2, but it's certainly not 5, and it certainly doesn't involve a platform team, right? We've tried some of these platform approaches before and always felt that given that we invest so many different categories, in so many different geographies, it's very tough to consistently help people move the needle, right? And it really took away from kind of what we're best at, because suddenly we're starting to manage people, managing a platform, et cetera, and took away from the investing approach. But a crypto founder in New York obviously has a very different need than a deep tech founder in Bangalore, right? Than a vertical SaaS person out of Canada, right? And so we just felt like, let's focus on what we do best, which is our style of investing. And that style of investing is very clearly described in our approach to it and done by a very small team.
Your anti-portfolio is just like on your website, like you talk about it all the time. I'm curious, like what do you do? Do you kind of like reflect on those things and like, hey, I missed that? Like how deep into detail do you go with like, hey, I was wrong on that thing? And does that actually help you, like looking back, does it help you kind of better in the future? Or is it just like, it's just good to have that kind of out there and like kind of reflect on it?
Yeah, I think we reflect on it. I mean, I wouldn't say permanently, but it's a good point to reflect on what did we do wrong in that process, right? There's a bunch of big misses that we had, right? And I think if you go back and say it was the right decision at the time, what we knew, I think you can be okay with that, right? We missed Shopify Series B at $100 million, right? Which today feels like very cheap, right? Given it's like a over $100 billion company. At the time felt very expensive, right? It wasn't clear, right, that at that time, right, that this could become a $100 billion company, right? And so I think it was the right decision not to invest because we're early stage investors, and it felt too late. But we learned from that, and later on invested in Coinbase at kind of a $1.7 billion Series D. That became a $60 billion company down the road, paid back our second fund twice over, right? But we learned from the early mistakes on Shopify to say like, well, you can selectively invest in late stage company if you have a thesis on the category, on the founder, and obviously, we should have done that with Shopify. So you learn from it, but you don't chastise yourself for having done the mistake. You adjust your filter if appropriate. But there's bunch of examples where I would say I would take the same decision today, right? That outcome was much better than what we had expected, but it was an outlier, and in 9 out of 10 cases, it wouldn't have worked that well, right? We took the wrong decision in this one case, but it was still the right decision, even though it's part of the anti-portfolio now.
I was chatting with one of your LPs earlier this week, and he wanted me to ask kind of just about like liquidity from like a fund perspective. Just, funds have a lifespan and you need to return, and maybe companies go beyond that from an age, and like when do you sell secondary? Like how do you kind of think about that?
Yeah, I mean, listen, this is one of the most important questions right now that's being asked by LPs, right? And I think we made a few mistakes where we're selling secondaries too early, right? In two very prominent Canadian vertical SaaS companies where we sold a stake or even a whole stake way too early, right? I think the way I think about it today is we're open to secondaries, but it needs to be at such a valuation, right? Where selling whatever, a small piece of your stake, let's say 20, 25%, has a meaningful impact on the DPI of your fund, right? So if by selling 20% of your position, you can pay back the fund one time or even 1.5 times, then that's a secondary we should take. If we have to sell 50% of our position, right, to pay back 20% of our fund, that just doesn't make sense. You're giving up a huge option for the future, and you shouldn't do it. Having said all that, what we have done just to solve for liquidity issues on a specific LP base, we have run secondaries for LP stakes across different funds over time, where we have institutional investors that invest in fund secondaries, buy out LP positions from people that want to have liquidity, and just align kind of those timelines. We can run the fund at the fund level. We can run it long term, let it compound until we have like the best possible outcome, perhaps in a public company or whatever. But on an LP level, we can adjust timelines again by people that perhaps after 7 or 8 years in the seed fund say, hey, listen, I'm happy to take a 5 or 6x on this fund and move on. And kind of an institutional investor that comes in with kind of a fresh timeline and kind of can write that LP stake further.
What have you learned about kind of like fundraising? Like obviously you're a founder in a previous life, raising money for a company, and then now raising money from a fund perspective. And like you've done that for a long time now. You've been very successful with that. Is there kind of nuances or differences? And what have you learned about like being really good at that?
Yeah, I mean, there's many things that are the same, right? I mean, in terms of you're thinking about what your product is, you're pitching your product, and you're trying to find the right investors for that, right? There's a few really key differences. I mean, the first one is the differentiation between VCs is not as much as between companies, right? I mean, ultimately, we're selling capital, we're selling money and to our entrepreneurs, right? It's not as differentiated, right? So what obviously kind of where you can differentiate is having had returns over time, right? And looking at a track record and kind of making the case that you can keep that track record alive and perhaps even improving it over time. I think the second thing is that the second difference is like, I think while there's lots of VCs that love investing early and in unproven founders, et cetera, I think LPs into funds are much more risk averse, right? So they don't really love taking that much risk, right? I think it's especially hard kind of funding, kind of raising a fund for an emerging manager, first-time fund, unproven investor, right? So I think as you move away from company to investor to VC to LP fund, right? LP, just there's less risk embracing that is going on.
How have you seen like the venture landscape shift? Like obviously you have like these mega funds, like there's rumors that some will go like public. I think you're seeing lots of like, at least anecdotally to me, lots of like new funds, especially in the US being started. Maybe none of this impacts you because you just invest in a certain style, but like how do you kind of see the venture ecosystem shifting, new players in the space, these mega funds, all these different trends?
Yeah. So I would say there's three big trends. I mean, the first one is just number of funds, right? And you've seen it, especially throughout 2020 and 21, like lots of new emerging managers, corporates that enter the space. So it has never been noisier, right? And just sheer number of investors and funds out there. It has never been easier to start a new fund, right? I mean, like 20 years ago, starting your own fund was nearly impossible. These days, much easier to be a solo GP. It's accepted. There's kind of investors that kind of love funding solo GPs. So lots of noise. I think the second thing is also much more specialization, right? I would say 10 years ago, most of the funds were generalist funds, right? Today, you have obviously lots of deep tech funds, lots of crypto funds, lots of climate funds. Now you have a whole generation of AI funds kind of coming up. You have some geographically focused funds. So lots of specialization. And then last but not least, like the emerging of these really large platforms, if that is an Andreessen or a Sequoia, a General Catalyst, a Lightspeed, that are kind of great LP products for the very large LPs, right? Because you ultimately can deploy tens of millions of dollars across different strategies, early, late, crypto, bio, healthcare, defense, American dynamism, whatever it is, perhaps even public vehicles. And so obviously they have scaled in a big way, given not only ambition to create that size and scale, but also like being a great LP product for the right kind of LPs that want to play in venture.
I feel like there's like a lot of advice out there for founders on like common pitfalls and things to avoid. What would be like your common pitfalls for like either new emerging managers or maybe just like any VC in general? Like what do you see as like common mistakes or issues or challenges that they go through?
No, I mean, at this stage, the question is really, I think every single LP will ask, like, what do you add to the market? What is your unique strategy? What is your unique access, right? And I don't think enough people think about that, right? I mean, I feel a little bad because when I think about my own journey, right, I don't think I asked that question in a big way, but it was also a different time, right? Like when we raised Version 1 Ventures 13 years ago, it was a very different market, way less managers, and perhaps entering as a generalist with a few interest areas was enough to kind of add to the market, right? It is not today anymore, right? And so today, me as kind of as somebody that has been investing in quite a bit of emerging managers, you really look for the differentiation, and the differentiation could be just a certain vertical where you just have a much better network than anyone else, right? And can help founders much better than anyone else. A certain strategy to source deal flows, right? Could be around media, could be around certain networks, right? Could be around certain accelerator programs, whatever it is. But you really need to kind of figure out how you fit in that market, because it's a busy market. I think there's no obvious hole in the market where it would say like, oh my God, if just somebody created another micro VC fund, that would be great.
How do you think about like, if you invest in like one type of company, like whether it's crypto or something in India, and then kind of growing from that, right? Like how do you kind of, you know, if someone hits you up for like a gaming company or robotics company, how do you kind of like, hey, like these are the things that, like, do you have a lane? Like, do you go outside of that? Like, how do you kind of think about that? What if you meet someone who's like extremely exceptional? You're like, this is amazing, but it's just like something that's just not on your radar.
We're completely opportunistic in that way, right? I mean, like in a certain way, we have a few areas that we're proactively interested in, right? But the reality is like every day there's entrepreneurs coming up with solutions to problems we didn't even know existed, right? And so in the end, we're pretty agnostic, kind of where we invest, as long as we feel like it's a special entrepreneur working on something unique, right? There's certain areas where I would just say, it's not interesting anymore, right? If somebody comes up with, I don't know, a D2C brand today, or pitches me another marketplace that kind of could have been created 10 years ago, or another L1 blockchain, et cetera, where you feel like, well, that was like 10 years ago, you should have done that. Today, it's just too late. That's more the filter that we look at, but there's lots of areas that we get excited about without them being in a big wave that we're currently watching.
And then how do you kind of think about like what stage to invest at? Like you talked about Coinbase and like that was kind of maybe opportunistic or a bit later. Like like how early is too early? Do you have like kind of a sweet spot? Again, it's opportunistic potentially all the time.
Yeah.
But like, how do you kind of think about stage?
I mean, it's almost everything we do is pre-seed and seed, right? And the check sizes are from 500,000 at the low end to 1.5 to 2 million at the high end, depending kind of size around, stage of the company. But yeah, ultimately, the way I think about it is we're taking a founder risk, right? I mean, we're betting on a founder, and it's not fundamentally different between pre-seed and seed. I mean, it's not that you know so much more at seed, right, than you wouldn't know at pre-seed about the founder, right? So we're completely flexible, investing very, very early on, simply just a founding team and an idea, and kind of how they kind of pitch that idea. I think the late stage deals that we have done were really very rare and opportunistic, right? Where we had a specific thesis on a category, on a company, specific insight. Coinbase is like a great example for that. But that's not really kind of where we would play at scale.
How do you think about like, with you and Angela, like, and like you said about building conviction quickly and maybe like, the traditional VC models, like there's like the partner meeting and they kind of all discuss things and they kind of get consensus. Like, how do you kind of think about that of like, do you have more blind spots or like I'm just kind of curious how you think about it when it's just like you kind of, Angela, are you bouncing things off other folks, other individuals, or is it truly just like, this is the feeling, I've been doing this for a long time, I'm like I have conviction around this?
It's the latter, right? I mean, sometimes we want to get a read on the entrepreneur, and that means like you talk to some references, right? And get from input from other people on it. But even that might sometimes not be a helpful thing. Like some of the best entrepreneurs were some of the shittiest employees, right? Because they were just like, they didn't like being an employee, right? They wanted to do their own thing, and that didn't look on them. If you talk to their boss, right, they probably didn't appreciate how they behaved at work. So you kind of the same thing when you diligence ideas, right? You have to be careful because the experts usually always say it's not possible. People have tried that, right? Lots of the innovation happens with people that are not compatible with corporate life, going for ideas that seem impossible, right? And so you have to be careful when you do reference checking and talking to experts, right? Not to get the wrong clues about on the wrong signals about that entrepreneur and that opportunity.
What are some other spaces that you're kind of excited about right now? Like obviously we chatted about India, like obviously still very interested in like crypto and other things. Like, is there like things within AI? Like I know AI is kind of everything now. What other kind of things are exciting to you?
I think in general, like robotics is a super interesting space, and we've done quite a bit of investments in vertical robotics for a specific use case. It feels like it's a little bit back at vertical SaaS. Like when vertical SaaS, the first companies came up, everybody was talking about the horizontal opportunities, right? The vertical opportunities seemed so small. It feels a little bit in the same way. People talking about humanoid robots and how they're going to replace the whole workforce. We're strong believers that there's lots of very specific use cases where you have to have a purpose-built robot that solves a certain problem and will always solve it in a much more efficient way than a humanoid robot that is kind of more kind of a general use case, right? And so we've been very bullish on that space.
I think like last question for me, but it would just be like when you enter the venture space, and I know you were making investments even before version 1, what are some kind of things that you had like strong conviction about, like whether it was about the founder or about how you should invest, and has that shifted? Have you just remained more consistent? I'm just curious like what the biggest change in learning has been over your career so far.
Listen, there's a few lessons I learned very quickly in a transition from entrepreneur to investor, or professional investor. Like I did 4 years of angel investing. I think some of the most important lessons I learned then, which was you really have to kind of be founder focused, not opportunity focused, right? I did way too many deals where I loved the opportunity, didn't love the founder, right? But as a former entrepreneur, you think like, oh, what could I do with the opportunity? You see yourself almost running it and what you would do with it. And the reality is like, you're not running it. Somebody else is running it, and your vision might not be their vision, right? And so focus on the founder and their vision versus your own perception of what you could do with that opportunity. I think the second thing that I learned very, very quickly is, you can never really influence the outcome of an investment, right? So never overvalue the input that an investor can have, right? Yeah. Sometimes like there's lots of these pitches, and we talked about like the platforms, like I can bend the trajectory of a startup. Like, no, you can't, right? Like this is not your role as an investor. You're not going to do it. So these are two really super important lessons that I learned before becoming a professional investor. I think after that, it was more the refinement of what's the swim lane that we're in. And I think our thesis was, for a longest period of time, was still way too much rooted in specific sectors, specific business models, for example, network effects, right? Versus just the founder quality in interesting areas, right? And so I think over time, we just got more and more high level in describing our investment thesis, maximum flexibility, but also even clear focus on what really matters, right? And so that swim lane got clearer and clearer, right? And kind of almost at a much higher level defined than before.
I love it. Well, thanks for taking the time. This was a lot of fun. I appreciate we could do this in person.
Perfect. So thanks for coming out.
Yeah, that was great.